Are you over 65 or 75 and worried about your retirement income in 2026? Listen carefully, because this could affect every single pound you receive. Your state pension is going up, but did you know it might also push you into paying tax for the first time ever? And that's just the beginning. Changes to pension age, tax rules, and new government tools like pension dashboards could completely change how and when you get your money. If you don't understand this now, you could miss out on thousands of pounds, lose access to benefits you're entitled to, or make costly mistakes with your savings. Stay with me, because in the next few minutes, I'm going to break everything down in plain English so you can take control of your retirement income, protect your finances, and plan for a secure, comfortable future in 2026 and beyond. Don't scroll away, you need to hear this. If you want to make sure you never miss updates that could affect your retirement income, this channel is made just for you. I'm sharing everything you need to know, no confusing jargon, no wasted time, just clear, practical guidance for seniors over 65 and 75. I'll be uploading more videos on this exact topic, so hit that subscribe button now and stay ahead of these changes. This channel is here to guide you every step of the way. Planning for retirement income in the United Kingdom during 2026 requires understanding several important changes that are happening right now. If you're over 65 or 75, these changes will affect how much money you receive each month and when you can start claiming your benefits. Let's walk through everything you need to know in plain English so you can make the best decisions for your financial future without getting overwhelmed by complicated jargon or confusing rules. The first thing you need to understand is that the state pension, which is the foundation of retirement income for most people in Britain, is going through some significant adjustments this year. The good news is that payments are increasing, which means more money in your pocket each week. Thanks to something called the triple lock guarantee, the state pension is rising by 4.8% from April 2026. What this means in real terms is that if you're receiving the full new state pension, your weekly payment will go up from £230 and 25 pence to £241 and 30 pence. Over the course of a year, that adds up to about £12,547 and 60 pence. For those of you on the older basic state pension system, which applies to people who reached retirement age before April 2016, your weekly payment will increase from £176 and 45 pence to £184 and 90 pence per week, totaling around £9,614 and 80 pence annually. Now, you might be wondering why these numbers matter so much. The simple answer is that the state pension forms the backbone of retirement income for millions of people across the country. However, and this is really important to understand, the state pension alone typically isn't enough to cover all your expenses in retirement. Research shows that a moderate retirement lifestyle, which includes things like a week's holiday in Europe once a year, eating out occasionally, and being able to afford your hobbies, costs roughly £23,000 per year for a single person. When you compare that to the £12,500 you'd get from the full state pension, you can see there's a gap of over £10,000 that needs to be filled from somewhere else. For couples, this gap becomes even larger, even though you might both be receiving state pensions. Understanding where your retirement income will come from requires looking at all your different income sources together, not just the state pension. Think of it like a three-legged stool, where each leg supports your overall financial stability. The first leg is your state pension, which we've already discussed. The second leg consists of any workplace pensions you've built up during your working years. These are pensions that your employers contributed to on your behalf, and they can make a substantial difference to your total retirement income. The third leg includes your personal pensions, which are schemes you may have set up yourself, along with any savings you've accumulated over the years. When you add all three legs together, you get a clearer picture of what your retirement income will actually look like. Let's talk about the state pension age, because this is changing in 2026, and it affects when you can start receiving your benefits. Right now, both men and women can claim their state pension at age 66. However, starting from April 2026, the pension age will begin gradually increasing until it reaches 67 by March 2028. This change affects anyone born between November 6, 1961 and April 5, 1977. If you were born before April 6, 1960, your pension age stays at 66, so you're not affected by this increase. If you fall into the affected group, you'll need to check exactly when you can claim your pension, because the qualifying age rises month by month during this transition period. You can use the government state pension calculator on the gov.uk website to find your specific pension age based on your birth date. For those of you who are already over 75, this age increase doesn't affect you directly since you're already receiving your pension. However, it's still worth understanding these changes because they affect your children and grandchildren, and knowing about them helps you give better advice to younger family members who might be confused about when they'll be able to retire. The government has also mentioned that the pension age might increase again to 68 sometime between 2044 and 2046, though some experts think this could happen even earlier. These ongoing changes reflect the fact that people are living longer than previous generations, which means the pension system needs to adapt to remain sustainable. One crucial aspect of planning your retirement income is understanding your national insurance record, because this directly determines how much state pension you'll receive. To get the full new state pension, you need 35 qualifying years of national insurance contributions. If you have fewer years, your pension will be reduced proportionally. The minimum requirement is 10 qualifying years, which entitles you to some pension but not the full amount. Many people, particularly women who took time off work to raise children or care for family members, find they have gaps in their contribution record. The good news is that you can check your record online through the government website, and if you discover you have missing years, you may be able to make voluntary contributions to fill those gaps and increase your future pension payments. Now let's address something that's becoming increasingly important in 2026, and that's the interaction between your state pension and income tax. The personal allowance, which is the amount of money you can earn each year before paying income tax, has been frozen at £12,570 since 2021. Meanwhile, the state pension keeps increasing each year because of the triple lock guarantee. This creates a situation where the state pension is getting very close to the personal allowance threshold. From April 2026, when the full new state pension reaches £12,547.60 per year, you'll only need £32 of additional income from any other source before you start paying income tax. This is a significant change because many pensioners who never paid tax on their retirement income before might suddenly find themselves becoming taxpayers. What does this mean for you in practical terms? If you're receiving the full state pension and you also have income from a workplace pension, personal pension, part-time work, or even significant interest from your savings, you could be pushed over the personal allowance and into the basic rate tax bracket, which means paying 20% tax on the amount above the threshold. This doesn't mean you're worse off overall because you're still receiving more money thanks to the pension increase, but it does mean that the net benefit you feel in your pocket will be slightly reduced by the tax you have to pay. Understanding this helps you plan your finances more accurately and avoid any surprises when your tax bill arrives. For many pensioners, especially those over 75, additional sources of income beyond the state pension make a significant difference to quality of life in retirement. Workplace pensions, which are pensions your employers contributed to during your working years, typically provide the largest supplement to the state pension. Research shows that workplace pensions increase the average weekly income for pensioners by about 11.8%. If you're fortunate enough to have worked for employers who offered good pension schemes, you might have built up a substantial pot that now provides you with regular monthly payments. These workplace pensions can be structured in different ways. Some provide a guaranteed income for life, similar to the state pension, but from your former employer's scheme. Others give you a pot of money that you can draw down gradually, giving you more flexibility but requiring you to manage it carefully so it doesn't run out. Personal pensions and private savings add another layer of financial security to your retirement income. Many people over the years have set up their own pension arrangements outside of workplace schemes, particularly if they were self-employed or worked in sectors where employer pensions weren't common. These personal pensions now form an important part of retirement income planning. You can typically access your personal or workplace pension from age 55, though this minimum age is scheduled to rise to 57 from 2028. One attractive feature of these pensions is that you can usually take up to 25% of your total pension pot as a tax-free lump sum. For example, if you have a pension pot worth £100,000, you could take £25,000 completely tax-free, either as one large payment or in smaller portions spread over time. The remaining £75,000 can then provide you with regular income, though this income will be taxable. Let's talk about some practical strategies for making the most of your retirement income in 2026. The first and most important step is to get a complete picture of all your income sources. Many people are surprised to discover they have more pension pots than they realized, especially if they changed jobs several times during their working life. Each time you changed employers, you might have left behind a small pension pot that's still sitting there waiting for you to claim it. The government is introducing something called pension dashboards by the end of 2026, which will allow you to see all your pension pots in one place through a single online platform. This will make it much easier to track down any lost pensions and understand your total retirement wealth. Another important strategy involves timing when you take money from different sources. If you're still working part-time or have recently retired but haven't yet reached state pension age, you might want to use your tax-free pension lump sums or money from ISAs during these years, saving your state pension for later when you stop working completely. Individual savings accounts, or ISAs, are particularly useful in retirement planning because any income or growth from ISAs is completely tax-free. If you've been saving money in ISAs over the years, you can withdraw from these accounts without worrying about pushing yourself over the personal allowance threshold and into paying tax. This flexibility becomes especially valuable in 2026 when the gap between the state pension and the tax threshold becomes so narrow. For those of you over 75, budgeting in retirement takes on particular importance because your expenses and income patterns might be quite different from when you were younger. Statistics show that pensioners over 75 receive an average weekly income of £322 after housing costs are deducted, compared to £389 for pensioners under 75. This difference exists partly because older pensioners are less likely to still have workplace pension income and more likely to rely primarily on the state pension. Understanding these patterns helps you plan for potential reductions in income as you move through different stages of retirement. It's also worth noting that your expenses might change as you get older. While you might spend less on things like travel and leisure activities, you might face increased costs for healthcare, home maintenance, or care support. Pension credit is an often overlooked benefit that can significantly boost retirement income for those on lower incomes, and it's particularly relevant for seniors over 75 who might be living primarily on the state pension. Pension credit tops up your weekly income to a guaranteed minimum level, which from April 2025 is £227 and 10 pence per week for single people and £346 and 60 pence for couples. If your total income from all sources falls below these thresholds, you might be entitled to pension credit. The benefit is means tested, which means the government looks at all your income and savings to determine eligibility, but many people who qualify don't claim it, leaving money on the table. Pension credit also acts as a gateway to other forms of support, including help with housing costs, council tax reduction, and free TV licenses for those over 75, so it's definitely worth checking whether you're eligible. Let's discuss some of the challenges and opportunities that come with the current pension landscape in 2026. One challenge is the ongoing uncertainty about future changes to pension policy. The government is required to review the state pension age regularly, and there's ongoing debate about whether further increases should happen sooner rather than later. Some proposals suggest the pension age could rise to 68 as early as 2037 or 2038, well ahead of the currently scheduled 2044 to 2046 timeframe. While this doesn't affect people already retired, it creates planning difficulties for those still working. On the opportunity side, the pension dashboards launching this year represent a significant step forward in helping people understand and manage their retirement savings more effectively. Another important consideration for retirement planning in 2026 relates to inheritance and estate planning, particularly if you're concerned about passing money on to your children and grandchildren. The rules around how pensions are treated for inheritance tax purposes are changing from April 2027 for many types of pensions. Under the current system, most pension pots sit outside your estate for inheritance tax purposes, meaning they can be passed on to your beneficiaries tax efficiently. However, new rules coming into effect will bring some defined contribution pensions into the scope of inheritance tax, which could affect how much your loved ones receive. This is a complex area where professional financial advice can be invaluable, especially if you have significant pension savings and want to ensure your estate is managed efficiently. Healthcare costs and long-term care funding represent another crucial aspect of retirement income planning, especially for those over 75. While the NHS provides free healthcare at the point of use, you might face costs for things like dental care, optical services, prescription charges if you're under 60, and potentially long-term care if you develop health conditions that require support. The cost of residential care can be substantial, potentially tens of thousands of pounds per year, and this can quickly deplete savings if you haven't planned for it. Some people choose to take out specific insurance products to help cover these potential costs, while others prefer to keep accessible savings as a buffer. Understanding your likely healthcare needs and how you'll fund them is an essential part of comprehensive retirement planning. The role of part-time work in retirement income is worth considering, even for those over 65 and 75. Many people choose to continue working in some capacity during retirement, whether for financial reasons, social connection, or simply because they enjoy their work. The good news is that employment law protects older workers from age discrimination, and flexible working requests from people over 50 must be seriously considered by employers. If you're receiving the state pension and also earning money from work, you'll need to understand how this affects your tax position, but working even a few hours per week can make a meaningful difference to your overall income and can help bridge any gaps between what you receive from pensions and what you need to maintain your desired lifestyle. Inflation is a particularly important consideration when planning retirement income over the long term. The triple lock guarantee for the state pension helps protect against inflation by ensuring the pension rises each year, but the same might not be true for other sources of income. Some workplace pensions don't increase with inflation, which means their real value erodes over time. If you're 75 now and live for another 15 or 20 years, which is entirely possible given increasing life expectancy, the purchasing power of a fixed pension income will be significantly less in the future than it is today. This is why it's important to have a mix of income sources, some of which increase over time, and to review your financial situation regularly rather than assuming what works today will work forever. Regional variations in living costs across the United Kingdom also affect how far your retirement income stretches. Research shows that average retirement income varies significantly depending on where you live, with London residents typically receiving less relative to their cost of living compared to those in Scotland or the Northeast. If you're considering relocating in retirement, perhaps moving from an expensive area to somewhere more affordable, this could significantly improve your financial position. Selling a property in a high-cost area and buying something smaller or less expensive elsewhere can free up capital that can be invested to provide additional income, while also reducing your ongoing living expenses. For couples approaching or in retirement, coordinating your pension strategy can maximize your combined income. If one partner has a larger pension pot or higher state pension entitlement than the other, thinking strategically about when each person claims their pension and how you use your tax-free allowances can make a real difference to your household income. Remember that each person has their own personal allowance for tax purposes. So if one partner has substantial pension income that pushes them into higher tax brackets, while the other has very little income, there might be opportunities to use both allowances more efficiently. This might involve decisions about whose name savings accounts are held in, or how you structure drawdowns from pension pots. It's also worth understanding the support available if you're struggling financially in retirement. Beyond pension credit, there are other benefits and forms of assistance that many older people don't realize they're entitled to. These might include help with council tax, assistance with heating costs through programs like the Warm Home Discount, and various local authority schemes that provide support with everything from transport to home repairs. Many charities also offer specific help to older people facing financial difficulties. Organizations like Age UK provide free information and advice services that can help you navigate the benefit system and ensure you're claiming everything you're entitled to. There's no shame in seeking this help if you need it, and it can make a significant difference to your quality of life. Looking ahead to the rest of 2026 and beyond, staying informed about pension changes and financial matters becomes increasingly important. The government regularly announces updates to pension rates, tax thresholds, and eligibility criteria, and these changes can affect your planning. Setting up a routine to review your finances at least once a year, perhaps with the help of a financial advisor or by using free guidance services like the Money and Pension Service, helps ensure you're making the most of available opportunities and not missing out on money you're entitled to. Technology can also help here, with many banks and pension providers now offering online tools and mobile apps that make it easier to track your income, manage your spending, and monitor your savings. As we've explored throughout this discussion, planning your retirement income in 2026 as someone over 65 or 75 requires understanding multiple interconnected elements. You need to know exactly how much state pension you'll receive and when you can claim it. You need to track down all your workplace and personal pensions and understand how to access them most efficiently. You need to be aware of the tax implications of your combined income sources and plan accordingly. You need to think about how your expenses might change over time and ensure you have enough resources to cover both planned spending and unexpected costs. You need to explore whether you're eligible for additional benefits like pension credit that can boost your income, and you need to review your situation regularly because the rules, the rates, and your own circumstances will all change over time.